So thank you very much, Mr. Moderator, and good evening, ladies and gentlemen. I am not sure if I will be able to follow the two previous speakers because they have been so comprehensive. But of course, I will make an attempt. The topic, of course, is making your golden years golden. And just before I came here, I had a quick look because I said I think I should start by giving a joke, but I didn't find an appropriate joke. But nevertheless, I would like to share this one with you. So do not be despondent. Everyone is destined to get old. The so-called golden years is when we get old. But to mature is voluntary. And some of us never mature. But we do get old. So I wanted to start at the stage when the moderator said we should have had health and wellness. Well, Mr. Moderator, I have news for you because what I'm going to demonstrate is that do not wait until the golden years have arrived. You need to stay healthy. And you see I have this lovely young lady on the screen, so you've got to start at that stage. And of course, because I didn't want the ladies to get jealous, also, so we need to stay healthy. That is what is critical. Now I've been asked to cover a number of items, and I will take them a step at a time. Some of them may have been covered already, so I would not necessarily repeat. So in your financial planning, I'm not sure if you can see what's there. Creating, growing, and protecting your wealth. Of course, this is predicated on the fact that you have accumulated wealth, because if you haven't accumulated wealth, there wouldn't be anything to protect, right? So you need to start by being aware that there should be sound principles of financial management. In short, from the first paycheck, you should start to save. That's how you get sound financial management, from your first paycheck. We all at some stage would have to retire at some stage, provided we live for long enough. What must be borne in mind is do not procrastinate. Start, as I said, right from the beginning. Planning how best to utilize the funds that come into your hands should begin from day one. Notwithstanding that both the credit unions and the banks, the rate of interest is almost non-existent, and or it might be 0.5% or 1%. At the most, I think it's 3%. Notwithstanding those low rates, still do not procrastinate. Start to save. There are a few basic principles to follow. Disregard the natural human phenomena by trying to spend money that you don't have. We all love to spend and buy things that we do not necessarily need. When you are in your 20s and growing, what you need to do is to start to put, even though it's $10, start to put that aside. Sound financial management. And of course, the worst thing that you can do is to let a close friend or even a relative come to you and say, can you give me a loan? Believe it or not, in 99 out of 100 times, that loan is never repaid. So it is something that you've got to guard against, be it friend or close family. Once you have rid yourself of that money, kiss it goodbye. Can you afford to retire? Who wants to be at the age of 95? And Mr. Cromwell, he demonstrated that some older persons still having to work. There must be a time to say that I have worked sufficiently. I want to take a break from the routine. So once you get to the age of 60, which is the retirement age in Grenada, I strongly believe it is time to say goodbye to your job. But don't follow me. I've already gone 60 and I'm still working full time. But it's because I am extremely healthy. This one is a little bit difficult to see, so I need to get a bit closer. The question that must be answered. Has adequate provision been made for the time when you must retire? As you get older, your efficiency is going to decline, and of course, ill health could be one of the other reasons why you have to go. So those consequences must be taken into consideration. All preparations would have to be made so that at retirement, it is merely a matter of determining the best way to go. So you've got to plan bright and early. In Grenada, and Mr. Cromwell have already alluded to that, there are two methods of obtaining retirement funds. For those of us, because I wouldn't want to put myself there, who have not saved sufficiently or have invested sufficiently, and I will talk about investment in a minute. There is the chance of getting an NIS pension, but as he explained, the maximum you can get is 60% of $5,000, so that is $3,000. So if your salary at retirement or at age 60, as it is now, if it was $5,000, the best you can get, I think he said, was 56%, so you'll be able to get $2,800. So you see, immediately, you were working in September at $5,000 a month. In October, you are home, and all you would have is $2,800. That is guaranteed coming every month. So that's why it's critical to ensure that you have made enough investments so that there would be a return on the funds that you have invested. And of course, Mr. Lowe have already said, in organizing your finances, it is imperative that a will is made. And he has gone into the ins and outs. I just want to reinforce the fact that if you have got to organize your finances well, be sure to have a will. The existence of a will is a recipe for ensuring that your assets are well distributed and that there are no problems in the family. Now, by the time you get to the age of 60 and continuing, there should be no children around, I would hope. And in any case, if there are children, they should be able to fend for themselves. I would say by then you should have thrown them out of the house in any case. So they should be making it on their own. So as a result, your expenses, because don't forget, I just demonstrated that if the only income you have is an NIS pension, you will move from $5,000 a month to $2,800 a month. And that would be the maximum. Consequently, your expenses should be reduced accordingly. But that does not necessarily always happen. You know, there is a phenomena that we call zero budgeting. What that really means is every household, I just want to press that fact, should at least have a budget which would indicate that the income is $10, the expenses should be no more than 10. That leaves you, of course, with zero. So zero budgeted. When you do your budget at the end of every month, that 10 for expenses should include savings. Zero budgeted. Don't say, what is left, I will save. Always include in your budget an element of savings. I was asked to have a look at this as well. A good debt as against a bad debt. It is my view that all debts, and I believe the credit union would tell you that as well as the bank, because once they give a loan, they are beginning to think that I have to make provision for the possible losses that is associated with that loan. So I tend to say that all loans can turn bad if circumstances change. And I've already said, if you lend, of course, to family, you may as well say goodbye. And of course, only lend, if you must, what you can afford to lose. Right? Only lend what you can afford to lose. Pension plans, I wouldn't go into it because Mr. Cromwell have already spoken about it. So we want to look a little bit at investments, which is the kind of thing that you should take care of in order to supplement your income at retirement. So while you're still strong and able to work, seriously consider investments. Now, investments in Grenada I would say the number one is the number one would be in property. House and land. And talking from my own experience, over the last 25 years, over the last 30 years, I would say properties have almost doubled in value. So when you are in your 30s, because at that time you should be able to afford a mortgage, it is the time to acquire real estate, right? It gives you an opportunity during your working life to be able to pay off the mortgage so that on retirement, you know you have a sound investment which can be sold. Notwithstanding the downturn in the market as it is still the best form of investment in Grenada, right? It is by far the best form. And as the older people will tell you, land cannot spoil, right? It will always be there. So it's one way to consider your investment from now. Investment in property. Now, we only have a few public companies in Grenada, and only last night, someone said, these companies have stopped paying dividends. I'm not sure if any of the bankers here who are in public companies would want to agree with that statement. But I would also like to advise that apart from your investment in property, your investment in a company like the Grenada Breweries, that's a public company. Republic Bank, it is a public company still. RBTT, even though the last time I got 28 cents dividend, and I promptly sent it and make sure I deposited it. I didn't want to, throw it away as some people did. But those kind of investments are something it's good to have on retirement. What I can say to you, for example, is Grenada Breweries, over the last 3 years, have paid in excess of 100% in dividends. So if you had an investment in a company like that, you have invested $100, and in 3 years, you have got back that $100, and you're continuing to get. And of course, I would like to also say the same thing for Republic Bank many years ago, because they were paying extremely good dividends, and all of a sudden, Mr. Johnson came to work there and he stopped paying dividend. I don't know why. And of course, a third form of investment is insurance contracts. I remember when I just left secondary school many moons ago, almost the first week I started to work, an insurance salesman came and said, "But you must buy." And he gave all sorts of explanations and whatnot. And I said to him, "Look, I haven't even got pay. How can I come and buy a policy?" But notwithstanding that fact, an insurance contract is a savings. The returns would not be necessarily consistent with the amount you put in because it does not have a cash value until after the first 5 years or so. But in case you die in between, you know, your young family would have been guaranteed $10,000 or $50,000, whatever is the amount on the life policy. However, if you lived to 60 and more, then you can cash in the policy. And the premiums that you paid, what you would find is, if you had expended, let's say, $15,000 in premiums, you should be able at that stage to have $25,000. In fact, again, a personal experience, I did buy a retirement annuity, and by the time I got to retirement age, it more than doubled. It more than doubled. So if I paid $10,000 in premiums, I was able to get a check. Because, see, I did not wait to say I want a monthly pension. I took the cash value one time. So instead of having to wait and get $1,200 a month, I took my $20,000 and I ran away with it. So I'm saying all this to say that insurance contracts are still a good form of investment, right? So you have these three alternatives. Real estate, which I would put as the number one. Purchase of shares in public companies, because I wouldn't want to say do it in a private company. There are all sorts of other things in private companies. In public companies. Because notwithstanding the fact that some of these companies, as I say, are not paying a dividend at this point in time, there must be a time when they have to pay dividends. And at the same time, your shares are increasing in value. So the share you bought, and those persons who may have bought shares in Republic Bank, for example, they would know that the shares, when they first went on the market, they were $15 per share. You can now sell those shares for $50. And at the same time, it was about 10 years ago, if you had one share, you got, well, if you had two shares, you got one. To make it simple. So that your investment would have doubled in the 20 years that Republic Bank has been a public company. Mr. Johnson, you're free to talk about it because you're a public company. Yeah, the shares are on the Eastern Caribbean Stock Exchange. Their accounts are published in the press. And it's the same with RBTT. Even though RBTT doesn't have I would say they don't have as many shareholders as Republic Bank has, right? Well, I see I'm being shown time, but I just want to say, for your retirement, you cannot depend on the pension that you would get from NIS or even from the one that you may have. And you only heard that 10% of companies in Grenada have retirement plans. So you must, at least if you want to live, or the term has been said, you don't want to retire in poverty. So if you don't want to retire in poverty, go for your investments. So thank you very much, Mr. Moderator.
Thank you very much, Henry. Very enlightening. And I have to say thank you for that qualifier at the end, that some banks are not paying dividends for now. And I'm sure Musa has something to add to that. So I'll hand you over to Musa. will give his comments on your presentation, and then we'll take questions. And before we close, I just invite Carol to come back and tell us a little bit about GARP and etc. Over to you, Musa.
All right, so thank you very much, Keith, and good evening to everyone. Mr. Henry did say that he didn't know if he could have matched up to the two previous speakers, but there's a saying that you save the best for last, and I'm sure it was no coincidence that his presentation was the final one. So I must say that it was very comprehensive, and the advice given is very profound, and certainly the experience that he has came to forth. It is said that retirement is a time when you stop working and start living. And it's certainly the golden years that we all look forward to at some point in time. And more often than not, although it's an event that comes along at that point in time, it's something that we do not plan for, because we are so preoccupied with now and living now that we don't plan for then. So it's something that is an oversight, and it's something that really requires the attention, and I must commend the central bank for coming up with this initiative. And also GAP, I mean, the point was made about educating our people and the role that NIS could play. But I certainly think it should be a collective effort among everyone, all the various stakeholders, not just the NIS taking the spotlight, that we need to educate our people for the benefit that is to be derived from the services of the NIS. But what Mr. Cornwell, when he made the presentation, what came forth was the over-reliance on NIS for providing the pension benefit. And there's a vacuum from the employment sector, from the employers, in terms of the number of employees providing benefits for their employees, and how important for us also to ensure that there's a savings to buffer that. Now, Mr. Henry mentioned a number of areas that we need to focus on to ensure that we plan for those years, and one of the things he mentioned is to start planning early and putting aside savings, and that is so fundamental that you need, this is within your control. And he mentioned about putting savings as an expense, and certainly it is something that we also overlook, that when you do your budget, and I'm hoping that we all do, and as Mr. Lowe said, I think they said doctors are the worst patient. I think bankers also are not good budgeters. So, but certainly when we're budgeting, it's something we should also do, and put your savings as an expense, so that you can have that buffer as you go along. And we need to be sensitive also about the rate of interest, the rate of return that you get. And we know that the environment that we operate in, there are varying rates of interest. So we should factor that in terms of how much we save, how much we need to save, in order to ensure that our savings accumulate, and the compounding factor is affected. And also there's a cost to savings now, so we also need to factor that in. And Mr. Henry also mentioned about not spending money that you do not have. And that is where the issue of credit comes in, and credit card. And as an attractive as a credit card can be, this is something that when you have, you need to manage. It's called a credit card, meaning that there's a credit on it, there's a limit on it, and when you use the monies, you have to pay it back. Now, credit card interest is the highest interest, is the most highest costing loan that you can get. Also, because of the risk associated with credit card lending. But of course, it's the most attractive one, because you think it's something easy to get, and you can just swipe your card, use the money, and you just pay the minimum amount. Now, what happens, if you keep paying the minimum amount, the outstanding balance keeps accruing interest, and then you find it just keeps accumulating. So it is a convenient tool, but you have to use it correctly to ensure that it does not get you into a hole, right? So it's a tool for convenience. And then Mr. Henry also mentioned about reduction when we start receiving a pension, and we noted that the maximum you can get, and that would be in 2021, was 60% of your income, and you only have a ceiling of $5,000. So you have to plan for that, that when you reach that age and you start receiving a pension instead of a salary and a reduced amount, you have to ensure that your expenses are matched so that you don't exceed your income at that stage. And just like how you plan for your income at that reduced level, you have to ensure that you manage your expenses so that it becomes manageable for you at that point in time. So this is where you have to ensure that you cover your expenses and you cover your debts before your retirement age, to ensure that any high debts and high expenses that you have, you incur it 5 to 10 years before retirement, so that when you reach your age of retirement, your debts would have been amortized. Then we spoke about the various opportunities in terms of how you can grow your wealth and investment opportunities and property. And certainly property is one of the safest form of investment. We, fortunately, in our part of the hemisphere, property appreciates in value. And Ms. Henry mentioned about the doubling of the property prices over the last how many years. And that is a very safe investment that we can all get into. I myself, I had my experience. I bought a plot. I wanted to buy a car when I was younger and, growing up. And my dad encouraged me at the time. He said, look, use my car, So he gave me his car. I used his car. He used to take the bus and go to work. And then opportunity came to buy a plot of land. And I said to him, there's a plot of land for sale. He said, buy it. I said, but I didn't know where it is. He said, buy it. So I bought the plot of land eventually. And I had it for a number of years. And then I sold it. When I sold it, I got double the amount. So he said to me then, if you bought the car then, if you sold it now, you'd have gotten less than half. But now you realize what you got is double what you paid for the land. So certainly it is one of the safest and best form of investment. And that's where, mortgage financing comes in. And most of the financial institutions ensure that, the mortgage retires before the age of retirement. Okay? So that is why when we say to our clients that, we should not exceed the age of 60, that is really to help us to ensure that when you reach that age, you're not overburdened to pay a debt to the bank. All right? It may sound attractive when you extend a mortgage beyond 60, because what that results in is that you pay less to the bank and you find, okay, it's affordable, I pay $1,000 instead of $1,500. Over the long term, of course, there's more earnings for the bank. But what happens is that when it takes you beyond retirement, when you have that reduced income, then you realize you have a higher leverage in terms of how much of your income goes towards financing that loan. And then you realize you're in problem servicing the loan. And then you realize you may have issues of foreclosure and so on. So this is one of the reasons why in the banking environment, the banking space, we ensure that the advice we give to our clients is to ensure that the loan does not, a mortgage, especially a long-term loan, does not exceed the age of retirement. One of the other things we also do is to offer creditor life insurance and personal loans, whereby, car loans, other personal loans that we offer, that they are insured. So in the event something were to happen and your eyes closed, then that asset is covered and we would recover the funds from the insurance company. Also, we also work with the debt servicing ratio. And again, this is advice that we offer to our clients that, a certain percentage of your income should not be exceeded in terms of how much of your income goes towards servicing the loan. And that again, so our clients sometimes say to us, well, how come, I earn so much I could afford to pay the loan. But what happens is that if you exceed a certain percentage of your income to service the loan, it means that the residual income you have is less to meeting other expenses. And you realize that as the other expenses become due, then you have a challenge meeting your obligation to the bank. Primarily when the bank grants you a loan, is not to foreclose on the collateral. It's to ensure that the loan is serviced satisfactorily over the life of the loan and it's not challenged, right? We spoke about the other investment opportunities and we spoke about shares. And shares, of course, in our environment is not something that we trade often and not we invest heavily in, but it's something that is prevalent, and we look for investment, return on that investment, and return on shares is more than a cash dividend. That is something that we have gotten to know, and we expect a cash dividend, and it's only when we think we get a cash dividend that you get a return. But you also get a share dividend, which is what was distributed by RBTT recently, and we paid in excess of $9 million out in a dividend share. All right, so you got additional dividends. So Mr. Henry, in addition to the 28 cents he spoke about, would have gotten several hundred shares, which were offered, which were given free. All right, so the difference was the fractional shares was given in the form of a cash payment. That's why you would have a small amount given in the form of cash. So you have, in short, you have return as cash dividend, and you have return as share dividend. And also you find what you find happening is that appreciation in the value of shares. So you may have paid, as Mr. Henry mentioned, that you may have paid X dollars for your shares, now it's worth more. So all these different forms are return on your investment. We spoke about the appreciation or return on shares in different sectors. And we have to accept the fact that the banking environment, or the banking sector and the economy are directly related, unlike perhaps banking and Caribbean, okay? So you find that when there's volatility in the economy, you find when the economy is going in a certain direction, the returns of your investment in that sector would fluctuate as well, all right? But these are things that we need to be sensitive of, so that you need to buffer your investment portfolio, so that you invest in different sectors, so that you find that when you have volatility in one, it's offset by another one. And finally, Mr. Henry also spoke about insurance contracts, and we know we all have different forms of insurance, and at some point in time we get a return, either in the form of a lump sum payment, or you have cash value that you can draw on. And what happens sometimes is that at that point in time, there's in that merriment you get that lump sum cash, and then you go on a tour, you spend it out, forgetting that after that you still have to come back and order your expenses. So it is very important to ensure that when we receive that return on that form of investment, that we continue to plan. It is, we have to enjoy life, we have to meet our current expenses, but as the Calypsonian said, when the carnival over, there's still other things to do. So when these funds are exhausted, there's still other expenses to honor. So I think, Mr. Henry, the presentation was very comprehensive, and I think the advice offered is very sound, and certainly I think our audience would have benefited immensely, and we certainly look forward to any questions that you may have. Thank you.
Thank you, Musa. You did a great job of augmenting Henry's presentation. So thank you very much. And of course, thank you for adequately representing the industry. I see Vaughn concurs. Okay, so it's question time. And we have, skin past bone. We have about another 10, 15 minutes for questions. So everything you wanted to ask, now is the opportunity. While you think of your questions, come right up. Just let me say that, I know this young lady, she was working for $3,000 a month. So I asked her, so are you saving? She says, yes. How much are you saving? 10%. Pretty good. So your expenses, 2007. Yes. Very good. 2 years later, she got another job, getting paid $5,000 a month. So how much are you saving? Of course, 500. So your expenses are now 4,005? No, but I was only save 10%. The point is, many times people say you must save so much percentage. And in certain circumstances, it might be appropriate. But as your income rises, you should forget about that percentage and determine what are your expenses and save all the rest. You'll be surprised what a difference it's going to make. Anyway, so gentleman in the pink shirt.
Mr. Joseph, I just want you to speak to not the people who are retiring within the next 5 years, but probably retiring in 10, 15 years. The ones who probably started saving when they just started the job, accumulated money, but because of increasing property prices, had to dump all of that money to the mortgage, and they've had to, well, the level of debt load is high. What tips can you give to them? Because they may want to have a pension, but because of certain circumstances, they cannot. So what tips would you?
Well, as I indicated, I'm taking it that you are doing zero budgeting. Which means that you have some excess. Notwithstanding the high value of properties at the moment, I am sure if you go to RBTT or Republic Bank, they will be prepared to facilitate you. So my advice would still be to invest in property now that you are still a very young man.
Very sound advice, but sometimes what it means is cutting back on some of your other expenditure. So you have to do the review to see, what am I spending money on that is not necessarily essential.
I don't think you really answered the question, because I think that based on salaries aren't moving, right? Property prices are growing, which means that mortgage payments are growing, residual income is less. So people are already in an environment where there's not much room to invest and have pensions. So what advice would you give? That's more or less what I'm getting at.
Well, I'm not sure if I could be more explicit, right? Because it really doesn't matter that property prices are high, right? You still have savings, you still have some time. My understanding is that all you would need is 10% deposit. And I'm sure, because you're still a young man, rather than getting a loan for 10 years, the loan could be for 30 years. Hopefully, conditions are going to change with time, because the world economy is improving. And I think you may have heard, for example, that Grenada's economy is expected to grow by 5% next year, which means that we are seeing an improvement. So it really doesn't matter, in my view, that properties are expensive. Still take the risk. Talk to Mr. Johnson or Mr. Musa here. Spend your 10% and pay your mortgage. It won't be 90%, but you have 30 years rather than 10 years.
And if I could say from my own experience, the name of the game is sacrifice. You have to be prepared, just like a structural adjustment, you have a spending adjustment. Oh, seriously, right? You have to sacrifice some of the things you would like for yourself until later. If you try and enjoy them now, you can find it very difficult, if possible at all, to achieve your goal of acquiring property. Sacrifice. Yes, Musa?
I just want to add that, yes, the property prices are increasing, and that is the good thing about investment in property. And if you don't invest now, it's going to get even higher. So the longer you wait, it's going to cost you more. But fortunately, we now operate in an environment where mortgage interest rates are lower than they were ever before. So the cost of financing now is cheaper. So while the property prices are higher or increasing, the cost of financing is cheaper. So it's something that you need to factor in, that, it costing you less to borrow, you will still qualify despite the fact that the property is costing you more. Now, one of the things that I would advise you in terms of ensuring an income, because you want that property to generate some sort of revenue for you, So, you know, you want to invest in a property where there's opportunity for you to develop some area of it which could, you know, you could rent out perhaps down the road. So, you know, when you're shopping around looking for a property, you want to buy something which probably has an upper floor and lower floor is vacant. So lower down the road, once, you know, there's equity in the property, when you pay down some of the mortgage, you can do an equity financing, you know, and add a floor and rent it out, and that can supplement, or even depending on where you are, you can perhaps pay the entire mortgage. And then it frees you up from paying a mortgage, and that money you could put aside. So that in itself is income for you, and it could be your pension income later on down the road.
You know, one of the things I often say to young people when they come to the office with their parents and grandparents, and most of the time they come with mommy and daddy and granny because they want to buy a car. And I say, and you know, I just continue to repeat, get the land, and then the land will buy the car in that way. But it's when I was in law school is when I really came to realize that the power of property, you know, to own property, especially in an environment like ours, because we don't have many things to invest in. But when you own some lands and so on, you know, you could either flip it and things like that. But let me just show you something about the price thing. The price is never too high. Because I've been reviewing some of these a couple of years ago, where in Fort Judy, and you know Fort Judy is one of the high-end places, that 3 lots of land, each over half an acre, was sold for $52,000, right? And that was in the 80s, right? Now, at that time, a headmaster was probably getting $5,000 or $1,000, right? And that would have been a lot of money to pay for a lot of land. You get the drift? In other words, then that you can't start saying, well, land is expensive now, because that is the price of land at this period. And if you sit back and say, well, I want to buy land because it's expensive, then you'll run into the same problems we had. Because the same Westerhall Point, I recall when Westerhall Point was $1 US a square foot, you know, for land. And that was expensive, you know, right? You see the point I'm making? So now, you know, as a young person, I would advise anybody to jam it still, ride the bus, and buy that piece of land, you know, and put your money there in that land, you know, because it's the best investment. Best investment you could ever go into in this country.
Absolutely. In any generation, any year, real estate is always expensive. And sometimes we say too expensive. And the other thing is, as Ferron is saying, you know, ride a bus. You don't need a car. Cars will come later.
We have a lot of buses now.
Any more questions? Yes, young lady.
Good night. I think I will place my question based on, just shift a little moment to gender, women and gender. And the question I like to ask is that we talk in savings, but I don't think we are looking at the single home that is headed by a mother, woman, headed household, and have a small salary and have children. How will she be able to save when she could hardly survive and sustain her family?
Carol, would you like to take that one? Or is it Chanel?
And I think that's really a question, because it's what's happening now. And it's so prevalent around us. We're seeing this a lot. And people are confused and they don't know where to go to get information, just as you're asking. At my association, we try to make sure that they save one and to have some kind of extra thing that they can do to make money. But I think we'll have to pass that on to the credit union as well, because It's a question that is being asked every day. What do? We have no money, and there's nowhere to go. Really? Can you?
When we do our financial planning sessions, we go to workplaces and we do different sessions with persons. I always say to persons, you can save $5. If you cannot afford $50 this month and you could put away $5, put away the $5. And there are other ways you can save. Sometimes just planting a little kitchen garden around your house. Maybe you get a flower pot if you don't have space. You plant some save. That is $2 less every Saturday when you go to the markets. No, it's reality. You can cut back on certain things. Even the electricity at home, unplugging all your chargers, taking off lights in rooms that you're not using, replacing bulbs with energy-saving lights. That can help as well, and it would reduce if it's $20 on your electricity bill, and that $20 you can put it somewhere else. I hope that helps.
I'm sure it helps. I don't know if it answers our question, but I'm sure it will help.
Yeah.
Now, the question really is a very complex one, and I'm not sure we have the expertise at this table to adequately address the issue. It's a lot of social implications there. But one thing certainly will help is to take advice in terms of, some self-help, gardening, and where possible, cutting back on some expenses. There's always room for cutting expenses if you have the will to do it. If you're willing to say, you know what, we're going to do without so for this week. I am going to not do so this weekend.